What's up, guys? My name is Connor King with Resolute Capital. This is about to be another Q&A video where I just answer some 2 or 3 questions maybe, and hopefully my answers will be able to benefit you in some way. But do know that they're just my opinions, and you should always consult a professional financial advisor before making any decisions with your money. And so I hope that you at least can have a few takeaways from the questions. Enjoy.
Okay, so first off, should I invest in bonds in my 20s, or is that just something that people do when they get closer to retirement?
That's a good question. Bonds are definitely one of the most conservative investments out there. The only things that would probably be more conservative would be a savings account or a money market account. And so they're quite conservative, and there's still a little risk to them, but on the scale, they're very non-risky. And so, if you have 40, 30, 40, 50 years until retirement, investing in bonds now could really cripple your returns that you could achieve if you were in more risky funds, like the S&P 500 index. So, probably I would recommend to not invest that much in bonds right now. But if you're a very cautious person and you don't have a good understanding of, how the stock market works, but you just want 3 to 4% return each year on your investments, then you could invest in bonds because that's about what it would return, and it would just be very stable, very consistent. It doesn't fluctuate that much. And so, I would probably say that if you're in your 20s, to maximum have like 10% of your investments in bonds, and maybe 20% if you just want a little more security. So that's my thoughts.
And on a similar note, as far as investing goes, should I be investing in actively managed mutual funds or more passive index-based funds?
That's a great question, and this is probably the greatest debate in the investing world from the very beginning until now. And I would definitely recommend, if you're debating this for yourself, to read the book The Intelligent Investor by Benjamin Graham, which is just a monstrous read. So only do this if you've got some time on your hands and if you want to just dive deep into understanding how it works. And also to read the book Common Sense Investing by Jack Bogle, who is the founder of index funds in themselves. And so if you read these 2 books, one, you'll have a great understanding of how everything works, and you'll have a lot of data and statistics to back up what you should do. And I've read The Intelligent Investor, and I'm in the middle of the Common Sense Investing myself. And I would say right now, I definitely would just feel way more confident about investing completely in the S&P 500 index and not doing any actively managed funds, because, these books just lay it out so clear for you that if you're investing for the long term, if you just buy and hold and never sell your investments and it's in the index fund, that 80 to 90% of the time you'll outperform all the actively managed funds because you're paying way less costs. You don't have to pay taxes on it because they're not turning over the investment so much. And so you'll be in a great place down the long run. It's a lot more guaranteed this way. But, if you're just trying to, if you really, really care about, trying to beat the market, and you're wanting to do everything you possibly can to beat it, and you're just super into investing and you just love it, then you could totally invest in actively managed funds, because there are a lot out there that have beaten the S&P 500 over a long time. And Dave Ramsey, well-known finance guy, he recommends only investing in actively managed funds, actually. And so definitely do some research on him and his philosophy as well, because that'll give you good insight as to what he thinks as well, from someone that is more, not as big of a proponent as index fund investing. So, I personally would recommend that, keep 80 to 90% of all your investments into the S&P 500, or either just keep most of it in S&P 500, but then just a little in actively managed funds. That way you can, still have a little bit of traction in that as well. And then also you could then, this is what I'm going to do actually. I'm pretty sure this is what I'm going to do. I'll keep all my investments in the S&P 500, but then 10% in bonds, and then 10% in just single stocks. And so 10% I'll just, go crazy investing in single stocks, super risky stuff, possibly private equity investing. And so that will then allow me to have some fun and keep up with stuff, but still be responsible and not blow all of our money investing in really risky investments, because I know it's only 10% of what we have. So that's my thoughts. Thanks for watching this video. If you enjoyed it, please like it and subscribe to our channel, where we post 2 videos every week. Also, leave any future questions you have that we would love to answer them down in the comments below. Also, leave any thoughts about the questions that we answered in this video, and we would love to get back to you, and we will see you in the next one.